This podcast is brought to you by AJ Bell and Shares Magazine. Shares Magazine is published by AJ Bell Media, part of AJ Bell.
Hello and welcome to another deep dive from AJ Bell Money and Markets. In this episode, we'll be taking a look at one of the defining technological breakthroughs of our time, artificial intelligence. And joining me on this cyber journey is Tom Sieber, editor of Shares Magazine.
Hi, Leith. Yeah, thanks for including me on the journey. So we've got a quartet of interviews with fantastic experts to drill down into the nuts and bolts of the AI market. We'll be hearing from Chris Ford, the fund manager of the Sanlam Global Artificial Intelligence Fund, for his perspective on the artificial intelligence boom.
We're also going to be talking to Stephen Yiu of the Blue Whale Growth Fund about why he's backing Nvidia but is selling down Microsoft.
And just to bring you a different perspective and a bit of balance, we'll also be talking to Rob Arnott from Research Affiliates, also known as the Godfather of Smart Beta, to find out why he thinks the stock market is currently in a bubble.
Right, before we get to all that, we've got Steve Frazer with us to talk us through the AI story so far. Steve is the tech writer at Shares Magazine. Steve, thank you very much for being with us. Can we just start off with a couple of really basic questions? What is AI exactly, and what are the different types of AI?
Yeah, hi Lathan, hi everyone listening in. So AI has obviously taken the investment world by something of a storm over the last couple of years, and a lot of people will have become even more aware of it with the emergence of DeepSeek earlier this year. We'll touch more on that later. AI at its heart is basically an advanced way of computers and machines learning in a similar way to humans might learn. So there are different ways of machine learning. So you have sort of narrow learning. So you go into more advanced fields in a sort of a deeper way, and you have more generic kind of learning. So imagine it in terms of like a child goes to primary school and they learn lots of basic stuff over a broad church. So for example, learn to count, they learn to spell words, they learn to identify objects and shapes, etc. And then they go into secondary school and then they start studying things a bit more specifically, like the sciences or like history or geography or mathematics, etc. So AI works in much the same kind of way. It's all about trying to replicate that human experience. And it even uses things like what are called neural nets. So these are effectively computer versions of our own human brains, which use neural networks in terms of trying to learn and trying to take on new information.
That gives us a bit of a flavour, Steve, of what we mean when we talk about AI. But in terms of how it actually might help businesses and consumers, can you give us a couple of examples of how artificial intelligence is already at work in the real economy?
Yeah, sure. So one of the really obvious ways it's at work is say a call center. So there's a company that's recently been taken private called Echo Technologies. It's just been taken over by Bridgepoint Partners. It operates in the call center space, and there's lots of automation there. Now, automation isn't the same as AI, but AI kind of builds on top of automation. Now, if you imagine like you phone up, one of the most frequently asked requests at a call center is like, I've forgotten my password and I can't log in. So if you imagine a human at the end of that phone call getting the same request day after day after day, it becomes a really monotonous task. So it's been increasingly automated. But just thinking about how people might say, I've lost my password, you might use different language based on what kind of background you've got. I've lost my password. I don't know how to log in. I've forgotten my login details. All of these things we take for granted as a human, but for a computer, it really needs to be taught that different ways to ask the same question are asking that very same thing. So add in things like people's accents. So understanding a Geordie asking the same question versus a Scouser or a Londoner or someone from the West Country, say. So this AI uses things like large language models, so LLMs, and also natural learning processing. And these are tools that are massive data sets of different ways that language can be used by humans, how questions might be constructed, so that AI systems can start to understand and start to predict what you mean, even if you're not asking a question in the most straightforward fashion.
You mentioned large language models there, Steve. I mean, what are the examples of that? I mean, ChatGPT is a large language model, isn't it? But there are quite a few out there.
Well, ChatGPT is called what's called generative AI, and generative AI is effectively a form of AI that can create stuff. So it creates, it can use the data it's been given of words, of images, of videos, for example, and it can start prompting the human user to create genuinely new things, like create videos, for example, from simple prompts. Now, ChatGPT only has that ability because it's been already taught through large language models and natural language processing. So LLMs and NLP are some of the building blocks on which generative AI and any AI system really sits, which is why so much data is required, why AI consumes so much data, because it needs to arm itself with such a vast tool set so it can actually start adding some genuine value to the human user.
The market has obviously got pretty excited about AI, and there's been a real bull run in technology names since ChatGPT was launched at the back end of 2022. Could you just talk us through which stocks have benefited the most and who are the big players in the AI market at the moment?
Yes, I mean everyone will probably, well, I say everyone, but you'll probably be aware that the Mag 7, so these are the seven, or what were certainly the seven biggest companies in the world, pretty much. So you saw Microsoft and Nvidia's, Tesla, Amazon. I mean, they all are tapping into AI in one shape or other. But there are lots of other companies, and it's not just companies with AI in their name. A company that's become a very big story over the last 12 months or so is Palantir. Now, this is a software company, effectively, that largely built its model on helping the US government and with various projects, and that made its story a bit difficult to tell because it wasn't allowed to tell anyone anything about what it was doing. It's since branched out into the wider corporate market, and its shares have just gone bananas. So they're up something like 230% over the last 12 months. But go back to when ChatGPT really got the ball rolling, sort of the back end of 2022, and Nvidia, which makes the most advanced graphics processing units, GPUs. These are the chips that really power AI. I mean, its shares are up over 700% since late 2022. So you know, they may have come off in recent weeks, given market volatility, but I mean, it's still been an outstanding success. And for a lot of people, a lot of investors, I think having access to something, simple, inexpensive S&P 500 tracker or a NASDAQ tracker or NASDAQ 100 tracker will give you quite a decent way into the AI world of investment. And that might be enough for many investors. But if you want more, there are other options as well to go and explore.
And I think in the last couple of weeks, we've kind of seen a sell-off in the US market, which is kind of, I think, being precipitated by fears over the economy from Trump's trade tariffs. But actually, if we look a little bit further back in the year, there was a wobble, particularly in tech stocks, particularly in Nvidia, because of the emergence of DeepSeek, which you've already mentioned, Steve. Was that kind of stir justified? Is there anything that we can learn from the emergence of DeepSeek? How much of a game changer was it for the AI ecosystem?
I mean, a big wake-up call, certainly. And in terms of, I mean, the Mag 7, for example, are spending enormous sums of money on AI. So I think that the prediction for 2025 is that between Meta, Alphabet, Amazon, and Microsoft, they're looking at spending something in the region of $320 billion of AI investment. And that goes right across the kind of whole ecosystem of AI. But what DeepSeek allegedly did was produce an AI model, train an AI model incredibly cheaply relative to what we've been used to in the past. Now, it reckoned its R1 platform, which is effectively the AI powered part of DeepSeek. was developed for a bill of about $6 million. Now, that's really, really cheap in terms of the kind of billions of dollars that have been bandied around by many of the big US dominant companies so far. But it's worth mentioning that DeepSeek is not without its skeptics. There have been many people have gone on record, including Elon Musk himself, Ted Mortensen, who's a respected analyst at Baird. They really have doubts about the validity of those cost claims because they're not verified. So we only have DeepSeek's own word for it that it costs $6 million. And lots of people seem to think that it was simply impossible to build that model for that kind of price. And the other side of it is as well, is that there's also skepticism that DeepSeek was able to build its R1 platform using the technology that it's allowed to have. So it claimed to be using Nvidia H800 chips, which are allowed to be sold to Chinese manufacturers under US embargo terms. But again, skeptics say that almost certainly they've got hold of much more advanced Nvidia H100 chips, which absolutely cannot be sold to Chinese markets under embargo rules. Now, how they might have done that, whether they've done that, I really don't know. And it's up to investors really to come to their own conclusions. But I do think it's probably sensible, certainly where Chinese businesses are involved, to have a healthy level of skepticism. So it's moved the dial forward. But interestingly, for the AI investment theme, if you like, you're seeing people like Jensen Huang, who runs Nvidia, saying, actually, this is just going to drive more and more demand. The cheaper it costs to tap in, create and tap into AI systems, the more demand it's likely to create over the long term. So really, it's probably seeded the wider AI market rather than put caps on it.
Thanks again, Steve, for taking us through all of that. Now, let's turn our attention to the Blue Whale Growth Fund. It's been one of the best performing funds in the global sector since it was launched in 2017, in part because of a high weighting towards technology stocks, and in particular, the darling of the artificial intelligence boom to date, Nvidia. Laith caught up with fund manager Stephen Yiu to find out why he's still backing Nvidia, but is less positive on the other magnificent 7 tech stocks, and has actually taken the decision to significantly sell down his stake in Microsoft.
Stephen, thank you very much for joining us today. We're talking about AI, of course. I think it's fair to say there's been quite a lot of excitement about AI, quite a lot of stock prices moving upward as a result of AI. Some people obviously saying that artificial intelligence has created a stock market bubble. I'm guessing from the fact that you have around 40% of your fund invested in technology, that's not your view. So if that's the case, what is that people who are saying that there's a stock market bubble are missing?
So there are a couple of things on the AI. It's a very big conversation. I think the first starting point, if you believe everything that we've seen from AI to date over the last 2 years is the end of the AI development, then we are definitely in a bubble. On the back of the DeepSeek advancement in terms of reducing the cost of training and also reducing the energy intensity, we probably have got too many GPUs. Of course, that is not our view. Our view is we are at the early innings of the AI developments, a bit similar to when Apple launched the iPhone back in 2008 and 9. We only had around maybe 100 apps in the App Store. But if you look at the number of apps in iOS today or Android App Store, we are talking about a few millions. So basically, we have not even seen the real AI yet, because I'm a true believer that generative AI is going to change my life or the life of many other people as well, whether it's on a personal basis or from a professional basis. But so far, I would equally agree that ChatGPT, Midjourney, image generation, and some of the AI applications are quite fun to play with, but it has not changed my life. So my view is I would encourage our listener to follow the AI applications that are yet to come. And the one area that I would like people to focus on is the agentic AI, which is AI agents. And that's very, very exciting. And we have just started that journey.
Okay, can you explain a little bit more about what AI agents are, please?
So currently, we have a very general purpose of, let's say, ChatGPT that you can go to ask many things. And if you, for example, if you have been to the British Airways website or some other maybe banks website, you will have seen an AI chatbot, which I would say is pretty primitive. It's not very user friendly, but at least it can tell you what you need to do to figure out how you can get your compensation if BA have canceled your flights, which I have been through a few times last year. But it doesn't do anything else. So what agentic AI or AI agents meant was that BA with a different service provider, let's say they're using Amadeus in terms of the booking, they would have an accounting system, I'm guessing, for example, maybe like Workday and some others. They could have an AI agent individually for those systems, which then the software developers or the provider would be doing this on the behalf of BA. So then what it meant at the end from our perspective is this AI chatbot that we're now speaking with currently would be able to speak to the individual AI agents across different systems. So for example, if you say my flight has been canceled on this particular date, then the AI agent will be speaking to the flight scheduling system to check how many hours was I canceled in terms of notification, because the compensation level will be very different, how much money you have paid them, so that they will be speaking to the AI agent within the accounting or booking system, etc., etc. And then, of course, we would still expect some sort of human oversight on top of that. So I'm sure like BA is not going to give us more money than they would be planning to do so. But then a lot of this nitty-gritty work can be done by AI, and we have just started that journey. So we haven't seen anything yet. The other side of the coin, which is even more exciting, I would say a bit scary, is if you look at Meta, what they're doing with our data through WhatsApp, Instagram, and Facebook. They have 3 billion users globally, more than 50% of the world population that are within the Meta ecosystems. They are, I believe, in the back end, with us knowing or not knowing or approval or not, they are training AI avatar or AI agent for every one of us individually, learning about how we speak to our friends, the posts that we share on Instagram, what sort of things that we like, what sort of holidays that we have been to. And ultimately, I can imagine that could be an individual AI agent or AI assistant, you call it, or AI avatar for every one of us. And the fun bit behind this would be, if I do have an AI agent myself, I will be sending my AI agent to speak to the BA AI agent to get my refund back if my flight has been cancelled. So I would probably pay some money for that, because obviously the journey to do anything with, for example, your flight booking is very painful.
Yeah, hopefully we don't get to the stage where you're sending your AI agent to do podcast interviews, Stephen. But I think what you've kind of shown there is that there's a lot of kind of potential uses here. Some of them you can see very beneficial for sectors like healthcare. Some of it quite scary in terms of what that might mean for jobs. Potentially privacy issues as well. But I mean, your job as a fund manager is to kind of pick the winners in such an emerging market. How difficult is that?
It's very difficult, and I would say that we have taken a very unconventional view in terms of our current positioning, that we are very pro AI infrastructure companies, such as Nvidia and Broadcom. At the moment, they're on the receiving end of any AI spendings. We are very cautious on the Mag 6, who are now going to spend over $300 billion in 2025 to invest into AI. That was supposed to be the free cash flow belonging to shareholders. They could have used it to do buybacks, dividends, or maybe cash on the balance sheet, or even acquisitions. But they have decided, as the most important priority for the big tech CEOs, they're going to spend $300 billion investing into AI.
That's quite interesting, Stephen. So what you're saying is that you're negative on those companies because you think they're spending too much on AI.
So firstly, spending too much money on AI is one thing, but secondly, who is going to be the ultimate winner? That is a big question mark. At the moment, the $1 bit of certainty if you are Nvidia and Broadcom, you are on the receiving end. You're guaranteed you're making money now as we speak, right? Nvidia is going to generate $200 of revenue today versus $30 billion 3 years ago. They're going to deliver $100 billion of free cash flow this year, higher than Microsoft $80 billion. So this is quite scary in a way that you can then see how high of a priority for the big techs are. But what we are saying here is the ultimate winners might not be the big tech, because the big tech has never been good with innovation. YouTube, Instagram, and WhatsApp were all acquired companies. They managed to scale it up because they are very well entrenched. And I think what DeepSeek have demonstrated, which we very welcome DeepSeek advancement or breakthrough, because they have lowered the cost of training for a lot of startups. I would like to see a few millions of AI apps, and that innovation is not confined by the big tech. And I think ultimately what the big tech would be doing, if, for example, Microsoft, which we're selling out now, after we have owned it for 7 years in our top 10, that's very significant decision, that we would expect if in time that Copilots, Office 365 Copilots, that Microsoft is developing in-house, which is not a very good product yet, they could spend a lot of money acquiring some other startup company to embed that within the ecosystem. But from a shareholder perspective, Microsoft is not going away, but the return for shareholders is coming down if they do decide to do that. So in terms of positioning, I think it's very important to note that we are underweight the Max 7, with the exception of positioning Nvidia. We still like. We have a small position in Meta. We have about 10% exposure to Max 7 versus about 25% in the index. And last year we were underweight too, but we had outperformed the market. The reason being was because we had something even better. We have Broadcom and TSMC, which wasn't part of the Max 6, and they have done a lot better than Max 6. So I think the journey is that is going to be a lot more differentiation, even though we are all talking about AI, that I'm a believer in AI, but who is going to win? I think that is the role of a good fund manager, that you identify companies that are going to win, not just playing, having exposure, playing a theme within the AI domain. So we're very differentiated in terms of our positioning today.
Okay, well, maybe we'll talk about the kind of broader kind of themes around infrastructure in a moment, but can we just focus in on Nvidia, because like it or not, it is kind of the poster child for AI. I know that there's a lot more to the AI ecosystem than that, but it's been one of your largest holdings for some time now. You actually bought it before ChatGPT and the huge rise in price. And, the stock has actually performed so well. I think I'm right in saying that you've had to sell some of that stock to keep within a 10% weighting, which is the maximum within your fund. And I think I've read that you've actually sold more stock in Nvidia than you've currently got in the portfolio. So can you maybe talk us just through why you liked Nvidia so much, and whether there are any shifts in the investment case at the moment, just with kind of, maybe the market not liking the huge amount of growth that it's still delivering, and also the kind of implications from DeepSeek as well?
So I will try to make my answer brief, because it's a very big conversation, and obviously it's one of the biggest companies in the world. So to summarize this in 2 minutes, then answer is very difficult, could be difficult. But a few things that's very important. The biggest competitor to Nvidia business, I would say, is Broadcom. The reason being, Broadcom is providing in-house GPU capability to the big tech. There's a natural shift of money being spent with Nvidia to Broadcom, which is to have it in-house, so that it's cheaper, you control it, you're not dependent on a third party supplier.
That's people like Meta and Microsoft developing their own chips. Broadcom is doing that for them, whereas Nvidia kind of gives you an off-the-shelf product that doesn't change depending on who you are.
Correct. So
right?
late last year, when Nvidia was over $3.4 trillion, we actually were more positive on Broadcom. I mean, we bought Broadcom at around $500 billion market cap in May 2024, and then late last year it surpassed $1 trillion. At the moment, it's about $900 billion. So we like Broadcom a lot more last year, so we did reduce our position in Nvidia. But recently, we have actually bought back a lot of shares that we sold, let's say last year, to increase our position in Nvidia, just short of 10% again. Now, the reason being is, of course, if you follow the development in Nvidia share price this year, it has gone down about 20%. So from our perspective, the fundamentals or the earnings power of Nvidia remain unchanged. There's no changes in our view in terms of AI, no changes in terms of Nvidia's positioning, competitive positioning, market leadership. I will come back on the DeepSeek in a second. And hence, and to us, the valuation has gone down 20% cheaper. So we are buying more shares. Nvidia today is about $2.7 trillion versus 3.4 a few months ago. But I will outline 2 pointers. One is DeepSeek is not a competitor to Nvidia. DeepSeek have not developed another GPU to rival Nvidia. All the trainings was done through Nvidia GPU. They just managed to do it more efficiently that the Western big tech company didn't manage to do before. So there's a lot. So what we were saying earlier was that it's going to enable a lot of startups who doesn't have access to billions of dollars to invest into GPU to come into the market to develop market fit product with millions, and then they can raise billions or sell the company to some other bigger tech company. So this is very welcoming. It's a lot like your iOS apps that we are seeing. We want more apps that we can play around, and I do not believe the big tech should have a monopoly in terms of that. But the only thing that I would say in terms of the moat of Nvidia, if you want to remember one single thing, that Nvidia currently, because they have been a pioneer in GPU since Jensen Huang started the company more than 20 years ago, they have created this language, proprietary language or platform called CUDA. It's a software platform that you need to program on if you want to use GPUs from Nvidia. Fair is this exactly the same as you want to write an app for Apple iOS or maybe Android App Store. So there's a lot of apps that are being programmed on Apple iPhone, which will be completely different if you were to replicate the app in Android App Store. Currently, there are 6 million software engineers globally that are developing AI applications using NVIDIA GPU and the programming language, which is called CUDA. And I would say to you, 6 million software engineers that's not part of NVIDIA's payroll is a very big number. For anyone to come in now, for example, AMD is going to come in, it's very difficult. Difficult doesn't mean it's impossible. Difficult means you need to firstly convince anyone to write some apps for you in your AI apps for you in your new ecosystem to utilize an AMD version of GPUs.
In a new software language, basically.
Yeah, software language. It's proprietary software language, exactly the same as the Apple iOS. If you want to program an Apple iOS, it's a unique programming platform that it doesn't work if you want to copy and paste the code into the Android App Store. So I would say that that's 6 million software engineers that have been trained. Any AI application today have been developed, 90% of them will be developed using NVIDIA GPU and the language. That is a very strong moat. I'm not saying no one is going to come in, someone is going to come in, but it's just going to take a bit longer, and NVIDIA is not stopping. That 6 million could be 10 million in a few years' time.
Okay. And I mean, you said that you're at the moment very keen on the kind of infrastructure providers, the chip makers, Broadcom and Nvidia. You're obviously kind of selling down other Magnificent Seven names, but we're getting a picture here that this is a very big ecosystem, and there's lots of different parts to it. Is there a point at which you think you might actually move from the kind of infrastructure players into other parts of the chain, and what might that be? I mean, companies making AI applications, they're obviously going to be beneficiaries in the economy outside of the tech sector who are able to run their businesses more profitably. Do you kind of think that's a future step, or are you thinking about that already?
So we have a small exposure to some of these potential winners. I will highlight Meta and Oracle. So Meta is a bit easier to understand. AI, generative AI as a technology, is a commodity. Anyone can embrace generative AI to do anything. As we have seen, ChatGPT, which was the pioneer, followed by Google Gemini, a competitor to ChatGPT, we have Perplexity. Elon Musk have done a similar version in X, and then we have Meta trying to do something similar. So AI in itself is a commodity. Anyone can embrace AI within the ecosystem to do something that's been done. DeepSeek exactly is an imitator of that, right? So what makes AI company very valuable is the data. Data is the only thing that will differentiate one place to another. Microsoft, as far as Microsoft is concerned, Microsoft does not own any of our data. Meta does. We are happy providers of our personal information because we have not paid for our usage of WhatsApp since the beginning.
And why is that important? Is that because you can train the artificial intelligences using that data?
Using the data that is basically at the moment sitting with Meta, that you can't take it out, and we are still very happy to give them the information. And hence, when they then train the data, they will be able to offer us the product. And then Oracle is an interesting one. It's a bit different that they have databases, right? As you know, that there's two large database company in the world. One is SAP, the other one is Oracle. So a lot of enterprise data are stuck in to that ecosystem. It's very difficult to move out to another platform. It's another proprietary platform. So then if you speak to anyone to say, oh, how long does it take to move the data from Oracle to SAP or maybe to some other? I would say that time is at least 3 to 5 years. It's a very complex project if you want to do it, very expensive too. So then a lot of enterprise data are now be sitting either with SAP or Oracle. So then when they then start doing the AI agents with the data being stuck with the ecosystem, then the likelihood of them coming up with something very tangible, because they know us, not a generic AI applications. At the same time, we are already a user of them. They will be able to give us more analytics, or maybe they will be able to charge us even more for their service. So there's going to be some true winners. But at the moment, I think it's too early to tell. Too early to tell means these are not big positions. At the moment, I think the certainty, which we would prefer, is on the AI spending receiving end. Because Oracle, equally with Meta, are spending money with Nvidia and Broadcom. But ultimately, we're going to see a few players coming in. And last point I want to remind our listener, Google Search was the 7th search engine created. 7th. Where's the other 6? Google Search was not a pioneer, but they managed to get the algorithm, the search ranking, much better, much more significant in terms of the output than the other 6. And the other 6 are gone now. So I think this is what we're going to see in the AI application world too. So then you can try to find signs, but it's not easy yet to determine. And I would guarantee you, we are going to see a lot of startups that can actually crack the magic, and then the big tech company would be buying these companies. And I think, unfortunately, maybe from a public equities investor perspective, I think a lot of startups will be private companies, which will be difficult to get exposure to.
So, Stephen Yiu, thank you very much for joining us.
Thank you.
Thanks to Stephen Yiu for speaking to us there. Now, not everyone thinks that the artificial intelligence theme is a good investment, and there are plenty of people out there who think artificial intelligence is in a bubble. Our next guest, Rob Arnott of Research Affiliates, is definitely in that camp.
Yeah, Rob is widely known as the Godfather of Smart Beta for his pioneering work in that field. And I think it's worth just explaining what that is very briefly. Most indices like the FTSE 100 or the S&P 500 are constructed based on the market capitalization of the stocks within them. And that means that the amount of money that passive funds following those index allocate to stocks is heavily influenced by the price movement of that stock, because as the price goes up, so does the market capitalization. So a traditional index or passive fund allocates more money to stocks that have done well and less to stocks that have done badly. Now, back in 2005, Rob launched the first in a series of indices called Research Affiliates Fundamental Index, or RAFI for short. And the indices differ because rather than weighting stocks in the index by their market capitalization, what they do is they weigh them by their fundamental measures of the business. So things like sales, cash flow, dividends, buybacks and book value. And the idea basically is that the index reflects the economic value of companies rather than the stock market value assigned by the price. So it's an idea that's gathered a lot of traction over the years. I think it's fair to say Rob has some pretty interesting thoughts about the current stock market conditions. Here's what he had to say.
Rob, thank you very much for joining us today. Let's dive straight into it, shall we? AI, has it created a stock market bubble in your view?
I don't think AI has anything to do with the stock market bubble. I think people have everything to do with the stock market bubble. The narrative around AI closely resembles the narrative around the dot-com bubble 25 years ago, actually crested 25 years ago this month. The dot-com bubble was based on a narrative that the internet is going to change everything. It'll change how we buy and sell goods and services. It'll change how we get our news, how we get our information, how we communicate with friends, how we deliver product to clients, how we do marketing. It'll change everything. And indeed, that narrative was absolutely spot on. Narratives have the advantage of being usually largely true. They have the drawback, and it's a big one, of being entirely reflected in current share prices. So a narrative won't help you invest successfully. Finding glitches in the narrative, where the narrative is off target, you can make some good money on that. And where was the dot-com narrative wrong? It said this change is coming fast. The world is going to change faster than you can imagine. And the leaders of the dot-com revolution are going to be the leaders 5 or 10 years hence. Well, disruptors get disrupted. My favorite example is the Palm Pilot. Back in 1999, it was ubiquitous. Palm was spun off from 3Com in March of 2000 and quickly hit a valuation larger than General Motors. 2 years later, the Palm Pilot was irrelevant. BlackBerry was sweeping the market. By the end of the decade, BlackBerry was irrelevant. The iPhone was sweeping the market. Disruptors get disrupted. The narrative around AI is also largely true. AI is the real deal. It's going to rock our world. It's going to displace millions of skilled workers. It'll also create millions of jobs for skilled workers who know how to use AI. The narrative goes on to say the companies that are the leaders in AI are dominant players. They have a moat. They can crush their competition. They will be the dominant players 5 or 10 years hence, and this change is coming faster than you can imagine. There's a guy named Aschenbrenner who was one of the co-founders of OpenAI. He wrote a monograph, 180 pages, but it's well worth reading, in which he painted the future of AI. And one of his suggestions is that AI will, by 2027, this was written in 2024, early 24, by 2027, AI will consume 40% of the US grid. So we need to boost our energy production capability by 40% in the next 3 years. Not going to happen.
Okay.
And by the end of 2027, it'll be smarter than the collective wisdom of humankind. Is that going to happen? Yes, it is. Not in 3 years. Humans are creatures of habit. We embrace change slowly. And so the narrative is wrong in just the same ways that the narrative about the dot-com bubble was wrong. But you don't want to short sell a bubble because it can go longer and further than you can possibly imagine. This one already did. I think the AI bubble, I'll use the term, is indeed a bubble. These companies have huge revenues and huge profits, which is a little different from the dot-com bubble. The leading companies in the dot-com bubble, the narrative is there weren't any profits. There were lots of profits, but it wasn't on the magnitude of this one.
Yeah.
And so these companies are very real, very successful, and yet you can't dismiss the impact of competition. Competition loves a market where there's a 50% profit margin, where gross margins are 70%. loves a market where sales are measured in hundreds of billions of dollars. And the notion that Nvidia, to cite one example, can shrug off competition indefinitely is just naive. Brilliant company, brilliant leadership, path-breaking innovations, but there are other companies capable of the same. Look what happened to OpenAI with DeepSeek coming absolutely out of nowhere on 1/100th the budget of OpenAI and creating a product that's just as good as ChatGPT 4.5. Well, that's impressive. So bottom line is bubbles exist and they create wonderful investment opportunities, but those are opportunities to invest elsewhere. No technological revolution can succeed without happy customers. The customers have to be the biggest winners, not the innovators. Otherwise, the innovation flounders. And that's another nuance that people miss. So look for folks who are using AI in intelligent ways to leverage their capabilities. Don't look to pile on where everyone sees the opportunity and is pricing it as if it's going to happen tomorrow.
Okay. And we might come to kind of that back to that theme of kind of investment opportunities in a moment. I kind of just, I guess, want to get your feelings on, or your thoughts rather, on how overvalued the market is, because that's essentially what a bubble means. And what you're saying is we can't tell when it's going to pop. If that's the case, I mean, in terms of your view, how bad could the downside be? And if I could maybe ask you a similar-ish question, is what would the world need to look like in terms of valuations right now for you not to be saying that there's a stock market bubble?
Well, one of the things we look at, we invented fundamental index, and fundamental index chooses companies based on how big they are and then weights them on how big they are, not how popular, beloved, expensive, frothy they are. And so I view cap-weighted indexes as growth-tilted, momentum-chasing, popularity-weighted indexes, and fundamental indexes as indexes that mirror the look and composition of the macroeconomy as it is today. Viewed in that context, RAFI has a profound value tilt, roughly co-equal with the value tilt of conventional cap-weighted value indexes. The cap-weighted value indexes leave out all the growth stocks. None of the Magnificent Seven is in the Russell 1000 value index. But RAFI, therefore, has a value tilt, has a growth tilt relative to value because it's got the growth stocks in it, just down-weighted. But it also takes the deep value names and upweights them to reflect their economic footprint. So net, our value tilt is sometimes a little lighter, sometimes a little heavier than conventional value indexes. Right now, it's heavier because value is dirt cheap. So where am I going to with this fundamental index narrative? Fundamental index has about 20% of its weight in the 10 largest businesses in the United States. Cap weighting has about 40%, just before this semi-correction, 40% of its weight in the 10 largest market cap stocks. That means that the market is twice as concentrated in popular, beloved companies as the macroeconomy is. So that would suggest to me that these companies have room to fall, not 50%, because they are better companies and they do have better growth prospects, but a decent chunk relative to the market. Now, if the market also goes down, then the AI and tech-related companies could easily fall 50% or more. The dot-com bubble, the stock market fell 45%, the NASDAQ fell 80%, peak to trough. And here's a wonderful factoid. The cheap side of the market in the dot-com bubble was small cap and value. So the first 2 years after the bubble burst, from March of 2000 to March of 2002, how bad was it for the stock market? down 27% on its way to being down 45. Okay, that's rough. How bad was it for Russell Value? Down 4%. How bad was it for Russell 2000? Up 3%. How bad was it for Russell 3000 Value? Up 53% while the stock market was down 27%. So what's cheap can do just fine, even in a bear market, if it's cheap enough. Now, that rubber band between growth and value and between large cap and small cap is approximately as stretched today as it was at the peak of the dot-com bubble, which is not to say I think we're going to see a repeat of the aftermath of the dot-com bubble, the dot-com crash, but rather to say that directionally, that kind of outcome is not at all unlikely and is dismissed by the market as if it's not plausible or not at all likely. It is indeed likely, and the possibility of value to beat growth by double digits, for small cap to beat large cap by double digits, for small cap value to beat large cap growth by 20, 30, 40% is very, very possible. And I think that's where we are right now. I think we're looking at an inflection point.
And if we kind of just look at the current market, I mean, you've talked a little bit about value and small cap. Is that where you kind of see where you would be investing right now? Or, is it just looking outside the US, are there other markets that you think?
Yeah, I think we're in an opportunity-rich environment. I think value is cheap all over the world. Small cap is very cheap in the US and in emerging markets. Both are relatively cheap in developed markets outside the US, Europe, Japan, but not as extravagantly so. I mean, the Magnificent Seven are all US companies. That's a little weird, but it is what it is. And so the opportunity in value and small cap is more in the US than developed ex-US, and also in emerging markets. US growth is extravagantly expensive. I like to use the Shiller PE ratio. We came into the new year with a Shiller PE ratio of 37. Where was it at the peak before the dot-com bubble burst? 44. So 37 is within hailing distance of the all-time record valuation. Where was it on the eve of the global financial crisis, before stocks fell in the US by 50% and non-US by almost 60 and emerging markets by almost 70? How expensive were stocks then? 28. Now we're at 37. So that tells me that this market is frothy, expensive, and priced for perfection. Europe is priced at a Shiller PE ratio, at least at the start of the year, it was priced at a Shiller PE ratio of 18 to 19, half off relative to US. Emerging markets, 15. Emerging markets value, 10. And RAFI, fundamental index, in emerging markets, 8. If you can get half the world's GDP for 8 times its sustainable 10-year average earnings, that's pretty cool. But it only works for the patient investors who are willing to sit there and enjoy their 5% dividend yield and wait patiently. The notion of getting a 5% dividend yield on companies that are growing versus 3-ish for European government bonds is pretty wild. It really suggests that the opportunity is really quite remarkable in the markets that are out of favor at the moment.
And just finally on that theme, Rob, can I ask you, do you have any thoughts about the UK stock market? Because there's a lot of teeth gnashing going on in the UK about the UK stock market because it hasn't performed as well as the US. We don't have a huge tech sector.
Nothing has.
Nothing has. Yeah. And companies are getting bought out. I mean, you're a kind of US based investor. Do you think about the UK? Are we relevant at all?
I do.
Yeah,
I do.
And what are your thoughts on the market?
The UK stock market, I view as unusually attractive, even by European standards. By European standards, I mean Europe is cheap. It's cheap for a reason. UK is cheap for a reason. It's cheap because of a narrative. The narrative is that Europe can't tolerate successful businesses and winds up regulating them into the ground. The UK's embraced socialism, and Lord knows what that leads to. Okay, that narrative is entirely in the share price. All you have to do is see a little pivot politically towards a more enlightened view that success shouldn't be punished, that innovation and hard work should carry rewards, that we shouldn't feel victims relative to those who are creating a beautiful world around us. We should embrace it. Just baby steps in that direction is all you need for European stocks to absolutely trounce US stocks, because US stocks are priced for perfection. And perfection is not likely what we're going to get.
Okay, that's great. Well, thank you very much for joining us today, Rob.
This has been fun. Thanks for carving out the time for it.
Great stuff.
Thanks to Rob for all his insights. Quite an interesting one there at the end, a perspective that the UK is embracing socialism, I assume in relation to the Labour Party coming to power. I think there's probably some Labour Party members at the moment who might disagree with that quite strongly, but nonetheless interesting to get a US perspective on our market.
Now, for our final expert, we're very pleased to have Chris Ford with us, manager of the Sanlam Global Artificial Intelligence Fund. Since its launch in 2017, the fund has returned an annualized 18% a year, so not bad going at all. The fund's objective is to invest in companies engaged in the main activities associated with AI, but perhaps surprisingly, 60% of the portfolio is invested outside of the technology sector. Leif caught up with Chris to find out why that is and to get his take on where we are in the AI race so far.
Chris, thank you for being with us. Now, you launched the Sanlam Global Artificial Intelligence Fund back in 2017. So that was around 5 years before ChatGPT came on the scene, and we all started talking about artificial intelligence. So how big a step forward was ChatGPT in your estimation? And, you know, that kind of generative AI, is that now the future of artificial intelligence, or are there any other things that we should be looking at coming out of the AI space?
Yeah, thanks, Nathan. Nice to be here. So ChatGPT was, of course, important, but when we look back at the advent of ChatGPT several years ago now, you could see even at that point in time, if you were closely watching the space, that the underlying technology upon which ChatGPT is based, which is called the transformer technology, that's the T in GPT, was just the most recent of a number of fairly transformative iterations of the leading edge neural network topographies that had occurred over the course of the previous decade or so. And ChatGPT itself was not the first iteration of OpenAI's platform upon which ChatGPT is based. But what ChatGPT, the launch of ChatGPT did was really kind of rip the Band-Aid off, if you like, and cause everybody to kind of wake up and pay attention to the benefits that the transformer technologies could bring to generative AI. And it really was the moment at which AI came, almost like the lid was pulled off Pandora's box, if you like, and everything came flying out into the world, and that's what we now live with. So it was a moment of democratization, I think. It's the point at which AI was put in everybody's pocket in the shape of the apps that we now engage with all the time on our mobile phones. And we can begin to see for ourselves how these technologies are impacting our lives. But it's not the last word in artificially intelligent innovation. And I think at points in the course of the last 2 or 3 years, it's felt a little bit, particularly in the investment community, as though with the launch of ChatGPT, it was almost as though the curtain came down, history had ended, and ChatGPT had won. And we don't believe that to be the case at all. In fact, we still believe that we stand very much in the foothills of what stands ahead of us in the artificially intelligent world. And so that's one of the more exciting pieces of my job, to think about what might come next and how we might navigate our way around that world as still more powerful versions of ChatGPT, or perhaps indeed completely novel neural network topographies begin to bubble into the economy and deliver fairly extraordinary functionality and capabilities to us.
Okay. And I think when we're looking at your fund in particular, it's a specialist artificial intelligence fund. Yet, over 50%, I think, is invested outside the technology sector, which might come as a bit of a surprise. So when you're looking outside of the technology sector at businesses, what is it that you're looking for that kind of means that they have exposure to the AI theme?
We're very clearly looking for companies whose business models and economic future, if you like, are entirely dependent upon the artificially intelligent systems on which those businesses stand. And we can find those businesses within the tech sector, but very much outside of the tech sector as well. For us, while the technology is really interesting and very powerful, and some of our capital is questionably invested in those companies that are providing, selling the picks and shovels, if you like, for the AI world, the opportunity to significantly disrupt potentially far-flung parts of the economy through the use of artificial intelligence systems has been now a feature of our world for the last decade and a half or so. And if we can see where those artificially intelligent technologies are combining again behind the scenes, perhaps in potentially far-flung and somewhat overlooked parts of the economy, then we can invest behind the coalescence of those technologies with a far higher degree of confidence that the disruption that's likely to ensue will be powerful, meaningful, and deliver significant economic benefits to those companies that are on the right side of that Rubicon. And that's really what we look to do within the fund. So whilst understanding the technology is of critical importance, it's also very important for us to understand the corporate change-mindedness of the companies in which we invest, the degree to which the management strategies are aligned with the artificially intelligent future, and to understand that ultimately this isn't an exercise in winning Pyrrhic victories. We need to see these companies actually delivering enhanced economic outcomes as a function of their engagement with AI.
Okay. Can you maybe give us a couple of examples of companies outside of the tech sector where you're investing, where you think AI is a big driver?
But there are some really interesting examples outside of the tech sector. A longer-winded solution example, sorry, has been, for example, Netflix, which, although sometimes gets conflated with the tech sector, actually sits in the media space. And of course, many of your listeners will be well familiar with as customers of Netflix. But Netflix's ability to deliver its content in the way that it does is significantly inflected by AI, partly in the use of AI to manage the technical means by which the bits and bytes are delivered to your television. You may have noticed that you have far fewer moments where the content is buffering in Netflix, using Netflix's service than using others, but also by Netflix's ability to understand its audience and its engagement with that audience better than anybody else, which then allows it, through its own delivery of its own developed content, to reflect the desires of its audiences in a much more comprehensive and time efficient manner. And of course, that all drives engagement. So it's a great example of how, when confronted with this data-led approach to the delivery of rich content to people looking to consume video, Netflix was in a very significantly enhanced competitive position. A different example might be that of John Deere in the agricultural machinery space, which is using AI in a number of different ways significantly to change their business model. One of the features of John Deere's business is that they have very significant market share, particularly in North America and Latin America. And as a function of just having lots of green bits of machinery crawling over all those acreages in different parts of the world, they are now capturing information, capturing data on all of that acreage, and are now in a position to understand better how that acreage can be better utilized to drive crop yields higher, and to monetize that information by selling enhanced services to farmers. Now that's great, but what it does over and above developing an incrementally larger addressable market for John Deere, it changes the business model, because it gives John Deere the opportunity now, between the moments that a farmer might be looking to replace his tractor or a combine harvester, to go back to that farmer and have an economic relationship with them in the intervening period. And what we're seeing now, what we think is the bottom of the agricultural cycle, is John Deere's business model troughing at a significantly higher trough margin profile than the stock has managed to achieve in the past. It'll be very interesting to see over the course of the next 7 years, as we move into the next cycle, where John Deere goes next.
I think many people, when they think about AI, particularly within the kind of investment world, they think maybe of Nvidia, they think maybe of Broadcom,
Yep.
they think of the Magnificent Seven. These are all US companies. I mean, the two companies you mentioned there, kind of John Deere and Netflix, are also US companies.
Yep.
Is the US just really far ahead on this stuff? You run a global fund. Are you seeing opportunities outside of the US, or have they just basically got this AI race sewn up?
No, they don't, and we have about 40%, just under 40% of the capital of our fund invested outside of North America at the moment. I think one of the interesting features of the artificially intelligent world has been the extent to which I think in 2019 the previous Trump administration really woke up and smelt the coffee and understood that actually China had an awful lot to say about the direction of the development of AI, and a great deal of internally developed expertise as well. And we've subsequently seen over the intervening 5 or 6 years a number of sanctions imposed by North America, largely now, frankly, explicitly designed to clip the wings of China's capabilities in AI, largely focused on their ability to get access to leading edge silicon chips. So there are some very interesting things going on in China. China arguably leads the world in respect of automated vehicles. There are many cities in China where you'll see automated vehicles moving around the city. We're yet to see that really here in the Western Hemisphere, but it's coming more quickly than I think people apprehend. In the world of quantum, particularly into the world of quantum communication, which is an inherently artificially intelligent endeavor, there are very significant milestones that one can point to in respect of China's abilities there. But we don't just see it in China, we see it in Australia, where there are significant companies operating in the AI space. We have a company in our portfolio operating in the electric utility space, actually, in Australia. So it doesn't need to be just in tech, it doesn't need to be just in China, it doesn't need to be just in North America. But the North American companies do have a very significant role to play, and America is leveraging that wonderful competitive advantage that it's always enjoyed, which is that huge monolithic internal market, which just gives the opportunity to scale very quickly to companies with great technologies.
And how about the UK? Is there anything going on in the UK? The government's obviously quite keen to make itself a welcoming home for artificial intelligence.
Well, there's lots going on in the UK, and of course some of us were running around a decade ago talking to anybody who would listen about how important AI was. And here we are 8-9 years later, and the government's finally come around to our way of thinking. We have a lot going on here in the AI space here in the UK. Going back to the 18th century with Charles Babbage and Ms. Lovelace. The heritage of computing in this country runs long and deep. And really, you can see that no better here in the UK now than in the presence of DeepMind here in the UK. DeepMind being the significant home of Alphabet's R&D efforts, which are headquartered just to the north of King's Cross Station in London. But in Cambridge, you have significant operations there from Apple, from Amazon, from Samsung. Oxford has a significant presence. The Manchester University have significant operations in foundational AI. The Edinburgh School of Informatics has significant operations in AI. We have the University of the West of England with the Bristol Robotics Lab. So there's lots of foundational stuff going on here. The problem that we have here in the UK, as we always have here in the UK, is that of scaling up. So we have some fairly foundational questions to ask ourselves here in the UK, largely around aspiration, around how we scale up businesses and how we allow our stock markets to be fit for purpose. People, I think, perhaps sometimes forget that whilst it's great to make money on the stock markets are there to price capital and to provide capital to those companies that need it. What you get for that is a return that we as investors all hope to enjoy. But we've got to be prepared to provide that and able to provide that capital. And perhaps there are some questions that need to be posed there.
Sure. And you won't have escaped people saying that artificial intelligence is in a bubble. How do you think about that? Obviously, kind of your fund invests purely in kind of artificial intelligence. So what do you think when you hear people saying that?
Yeah, well, I'm long enough in the tooth, as you can as you can see, that I was running money back in the late 1990s, early 2000s. So I remember the internet bubble, and the internet bubble didn't look like this. Nvidia, as we sit here today, trades on a high teens multiple. Alphabet trades on 16 times earnings. These are not the expensive multiples that were associated with the peak of the internet bubble in 2000. So that doesn't necessarily mean that the markets must go higher or that these stocks must accompany those markets higher, but it does mean that the markets look very, very different today. And it's difficult, I think, to argue that these companies, many of whom I think would be regarded broadly as being emblematic of the artificially intelligent world, it's difficult to argue that these companies really sit in an investment bubble at this moment. There are some that are more expensive. Microsoft's a little bit more expensive. Apple's a little bit more expensive relative to their own history. But broadly speaking, they're not out of the realms of common sense. And I think that's something that we should keep in mind. These companies are some of the most cash generative businesses that the world has ever seen. And so, and this cash is real. Cash is cash, as they say. And so we should be not quick to overlook the cash generative capacity of the business models that are associated with the artificially intelligent world.
I'm sure it's a debate that will rage on, but for the moment, thank you very much for joining us, Chris.
Thanks very much to Chris Ford from Sanlam Global Artificial Intelligence for stopping to chat with us. So, Tom, we've heard a balance of views, I think, about AI today. Where are you at in terms of, your thoughts on, has the stock market got ahead of itself in the pricing of some of these prominent AI names?
I mean, I think in short, yes, is probably the answer to that question. But which stocks is a bit more of a difficult question, I think. I don't know whether it's right to say that AI is a bubble, but it's quite difficult, I think, for the market to work out exactly who the main beneficiaries of an emerging theme are going to be at the outset.
Yeah. I think that's the thing. I think, if we've heard a lot and you can be a believer in the kind of AI becoming a very transformational technology. But the question, like you say, is who are the winners going to be and what prices stock markets put on them already.
Yeah, that's right. And I think if you look at something like the dot-com bubble, which is probably sort of the closest comparison point with AI, clearly there were a lot of stocks that, went to the moon and then crashed. And, that's well documented. But there were obviously stocks that emerged at that time. You think of a company like Amazon, who have very much stood the test of time. And it has had clearly the development of the internet has had a transformative impact on them. So it is hard, I think, for the market to work it out. And you do get probably overexcitement about parts of the market about AI. And, I think it's been quite evident that some companies at least have tried to tap into that. It's become increasingly common for companies to be talking about AI almost regardless of what sector they operate in.
Yeah, and I think the one thing that for me, Tom, that kind of the thing that keeps flashing red is the Schiller PE ratio, which I think Rob Arnott mentioned, which is this kind of measure of stock market value. It looks at kind of price earnings over 10 years, and the kind of historical index goes back, over 100 years, and we're at just currently at a very, very high point of 35 times cyclically adjusted earnings. And if you kind of look back, the only times that's been higher is 2021, kind of during the pandemic when everyone thought technology is, going to take off even faster than perhaps it did. And then the dot-com boom. And the other thing is that kind of if you overlay on that kind of data, the 10-year returns from the S&P 500 in the following 10 years, there's a very inverse relationship between the kind of valuation point at which you buy in and the returns that you get from the S&P 500, which kind of is a bit of a worrying signal, I think.
Yeah. And what are the most dangerous words in investing? It's different this time, right? So
exactly.
Yeah. If you look at that pattern sort of going back over time, then you can understand why people might be a bit cautious. I mean, one other observation, I suppose, is that the stock probably most closely connected with AI, Nvidia, which it has, obviously been on an astonishing run. What might be worth kind of making note of there is that, to be fair, you mentioned the multiple, the Schiller multiple there for the wide market. I mean, Nvidia is actually now, having kind of come back a bit, is on around 25 times earnings, which does suggest that if the earnings forecasts are right, the kind of earnings growth has more or less kept pace, or, in some ways might even have gone ahead more recently of the share price. So, it's worth, I think that's the thing. You need to look at the detail. You need to make, your own judgments about whether or not this is really a business that can benefit from AI, but also keep tabs on the latest developments. Obviously, we talked earlier in the podcast about DeepSeek and the impact that has had. So you need to be alive to those kind of risks.
Yeah, and I think, to be honest, Tom, I find myself on this kind of just agreeing with the last person I spoke to about it. It feels like there are kind of compelling arguments on both sides.
Absolutely.
And I kind of think that it kind of encapsulates a difficulty that you've got in the market at the moment, because there's a risk of investing, of course, but there's a risk of not investing as well, because the market could continue to climb quite sharply and you could miss out on those gains. So the one thing I do cling to is the idea of regular saving, regular investing in the market, because that kind of hedges your bet a little bit.
Exactly. It solves that problem to a degree, doesn't it? I keep pulling out the kind of classic stock market idioms, but another one is that time in the markets beats timing the markets. And, that what you're talking about, that kind of regular investment, that kind of speaks to that, I suppose.
Thank you very much for being with us, Tom.
Thank you.
We'll be back later this week with a regular weekly AJ Bell Money and Markets podcast, and the deep dive is going to return next month when we'll be looking at the pension freedoms. 10 years after they were introduced, we'll be asking whether George Osborne's landmark pension reform has actually gone to plan. Thank you very much for listening. We'll catch you next time.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell or Shares Magazine. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.